The psychology of money in trading is unlike anything else. Think about it. Losing $100 on dinner with friends barely stings, but losing that same 100 in a trade can feel like the end of the world. Why? Because in trading, money isn't just money. It's a scoreboard of your decisions. It's your confidence, your future plans, your pride, compressed into blinking numbers on a chart. One moment, you're on top of the world watching profits grow. Next, your stomach sinks as the market flips, and you're questioning everything, your strategy, your patience, even yourself. This is why trading is never just about markets or technical analysis. It's about the mind. It's about how we think, how we react, and the emotional stories we attach to every dollar gained or lost. Money in trading doesn't just buy things, it buys emotions. And that's why it feels heavier here than anywhere else. In the real world, losing $100 might sting, but you'll shrug it off. A dinner, a gadget, maybe a pair of shoes, you got something in return. But in trading, a $100 loss is emptiness. Nothing to show, just numbers erased. And that absence cuts deep. Why? Because to the human brain, money is never just currency, it's survival. For thousands of years, resources meant safety, food, and shelter. When we lose money in trading, our mind doesn't see it as a digital transaction. It registers it as a threat. Our nervous system reacts the same way it would if we were losing food or protection. That's why your heart races, your palms sweat, and your stomach tightens at a loss. And here's the twist. Gains don't feel the same. A profit of $100 doesn't give you the same rush that a $100 loss takes away. Psychologists call this loss aversion, the idea that losses hurt about twice as much as gains feel good. Which means every trade isn't just numbers. It's an emotional tug-of-war. This is the first trap of trading psychology. We think we're dealing with markets, but what we're really dealing with is the ancient wiring of our own brains. The market isn't punishing us. Our own psychology is. Every trader lives in the space between two powerful emotions, greed and fear. Greed whispers when the chart is green, says, don't take profit yet. Hold a little longer. Just imagine how much more you could make. And so you ignore your plan, watching the candle climb, until it suddenly reverses, and what could have been profit vanishes before your eyes. Fear, on the other hand, shows up even faster. You enter a trade, and the moment the market dips against you, even a little, your chest tightens. You think, what if I lose it all? What if I was wrong? And so you exit too early, only to watch the price move exactly as you predicted after you've already closed out. Greed keeps you in too long. Fear pushes you out too soon. Together, they form the pendulum that swings traders back and forth, never letting them rest in balance. And here's the irony. Both emotions come from the same place. They're fueled by the stories we tell ourselves about money. Greed says, this trade could change your life. Fear says, this trade could ruin your life. Both distort reality, both cloud judgment, and both convince us to act against our own plans. This tug-of-war is what makes trading so uniquely psychological. It's not the market that forces bad decisions. It's our inability to master the voices inside our own head. If greed and fear are the raw emotions of trading, illusions are the tricks our mind plays to justify them. The brain is wired to take shortcuts, mental autopilot, but in the markets, those shortcuts become dangerous biases. Take overconfidence bias. You win one trade, maybe two, and suddenly your brain whispers, you've cracked the code. You see things others can't. Feels good, like you've outsmarted the market. But the market has no memory, and one lucky trade can trick you into risking far more than you should. Then there's confirmation bias. Imagine you're convinced a stock is going up. You scroll through news, charts, maybe even Twitter. And what happens? You only notice the information that supports your belief. Any sign that says sell gets ignored. Your brain builds a comfortable little echo chamber, and when the trade collapses, it feels like betrayal. But the betrayal wasn't the market, it was your own selective perception. Narrative fallacy is another subtle trap. Humans love stories, we crave them. So when a market move looks random, we invent a reason. It's because of the Federal. It's because whales are manipulating. It's because Mercury is in retrograde. We stitch together a story to make chaos feel orderly, but those stories blind us to the truth. Markets don't need a reason to move. And finally, the gambler's fallacy. After 3 losing trades, your mind says, I'm due for a win, as if the market owes you a balance. But the market doesn't play fair, doesn't keep score, and doesn't care how many times you've been burned. The next trade has the same odds, no matter what came before it. These biases make us feel smarter, safer, and more in control, but they're illusions. They don't protect us. They sabotage us. And the scariest part? Most of the time, we don't even know they're running the show. For many traders, money isn't just money. It's identity. Every win feels like proof. I'm smart. I can do this. I belong in the game. But every loss feels like failure, not just of the trade, but of the self. It's no longer my trade was wrong. It becomes, I am wrong. And that shift is dangerous. When traders tie their self-worth to their portfolio balance, the market becomes more than numbers on a screen. It becomes a mirror. A green trade makes you feel capable, powerful, in control. A red trade makes you feel small, foolish, even ashamed. And that's when revenge trading is born. You take another trade not because it fits your plan, but because you need to prove yourself again. To the market, to others, to yourself. The identity trap blinds traders to the truth. Markets don't measure intelligence or character. They measure risk and probability. Even the best strategies lose sometimes. Even the smartest minds take hits. Losses aren't personal. But when your ego is on the line, every loss feels like an attack. Professional traders understand something that amateurs often forget. Detachment is survival. They don't think, I lost, therefore I'm a failure. They think, I lost, therefore I paid the cost of doing business. One mindset fuels desperation. The other fuels longevity. The identity trap is subtle, but it's the reason so many burn out. Because when trading becomes a reflection of who you are, every fluctuation cuts too deep. And the market, ruthless as it is, has no sympathy for fragile egos. If the identity trap is the downfall of traders, detachment is their shield. The ability to see money not as self-worth, not as emotion, but as simple units of risk, that's where discipline begins. Professional traders don't sit at the screen thinking, if I lose this trade, I'll feel worthless. They think, this is one of 1,000 trades. My job is to follow my rules, not my feelings. They detach their emotions from the outcome and instead focus on process. How do they do it? Systems. A stop-loss isn't just a risk tool, it's emotional insurance. Prevents panic decisions when fear strikes. A trading journal isn't just paperwork. It's a mirror, showing patterns of greed, fear, and overconfidence that the mind tries to hide. A position sizing rule isn't about math. It's about making sure no single trade has the power to break your spirit. Detachment doesn't mean you stop caring about money. It means you stop letting money dictate your behavior. You train yourself to accept that losses aren't tragedies. They're business expenses. Just like a store owner pays rent, a trader pays with losing trades. It's the cost of staying in the game. Discipline, then, is choosing the system over the surge of adrenaline. It's exiting when your plan says exit, even when greed whispers, just a little more. It's holding firm when fear says get out now, because your rules say otherwise. The truth is, markets will always test you. The temptation to chase, the panic to run, the thrill of being right. It never goes away. But detachment and discipline don't eliminate emotion. They keep emotion from driving the car. They hand the wheel back to logic, back to process, back to the part of you that wants longevity more than excitement. In trading, survival comes first. And survival only comes when discipline is stronger than impulse. In trading, the hardest lesson to learn isn't about entries, exits, or strategies. It's about time. The long game. Most traders enter the market with a short-term hunger. How fast can I double my account? How quickly can I quit my job? That urgency is what the market feeds on. It lures traders with quick wins, then takes it all back when impatience replaces discipline. But those who last, the ones who actually build wealth through trading, see money differently. They don't chase fireworks. They build a slow-burning flame. For them, one trade doesn't make or break anything. It's just a single brushstroke in a much larger painting. Patience is their secret weapon. They know missing a trade isn't failure. Forcing a trade is. They know compounding small, consistent gains over years will always beat the thrill of one giant win followed by a devastating loss. They play the game like a marathon, not a sprint. This is where psychology comes full circle. Greed wants fast results. Fear wants instant safety. Impatience wants shortcuts. But the market rewards none of these. It rewards consistency, resilience, and the ability to endure boredom without self-sabotage. The long game means accepting that drawdowns will happen, that losing months are part of the business, and that wealth is built slowly, even in the most volatile market. It means trading not just for money, but for longevity. Because here's the truth most traders ignore. The market doesn't need you to be the smartest or the boldest. It needs you to still be here years from now. And only those who master patience, who treat trading like a lifelong craft instead of a lottery, ever reach that point. The psychology of money in trading isn't really about money at all. It's about what money represents: security, freedom, pride, survival. That's why every green candle feels like hope and every red one feels like loss. That's why the same $100 feels light in a store but heavy in a trade. We began with the heartbeat of a trader watching the screen, hope turning to panic in seconds. But now we see the deeper truth. The real market isn't the chart in front of us. It's the one inside us. It's the tug-of-war between fear and greed, the illusions that trick us, the ego that ties our worth to wins and losses. And the only traders who last are the ones who learn to master themselves, to detach from the emotions, to build discipline, to endure the long game. Because the market doesn't reward emotion, it punishes it. What it rewards is patience, process, and resilience. So the next time you sit before the screen, heart racing as the numbers flicker, remember this: you're not just trading against the market. You're trading against yourself. And the greatest profit isn't the money you make. It's the mastery you gain over your own mind.